Let's bring in the Executive Chairman of Yellow Brick Road Home Loans now, Mark Bouris. As we always do, our chat always seems to follow a date after a rate hike, and you know, I'm going to sound like a broken record because I have to keep asking you the same questions, Mark. But how does this affect a borrower, and how does this rate rise affect a lender?
Well, let's look at it from a borrower's point of view. So I did a quick analysis this morning. So on a $750,000 loan, a borrower has to earn another $10,000 per annum just to make these payments, extra payments, on a $750,000 loan. After all the increases, like we've had 3 increases, after those 3 increases. So that's $10,000 before tax, which is about $7,500 after tax. So that's a lot of money. That's a lot of coming out of the borrower's pay packet every month, which they either have to earn or they're now going to have less to spend in terms of discretionary spending.
But this has all been priced in, hasn't it?
When it comes to lender...
Yeah, sorry. Yeah, go ahead there. Go, and then I'll ask another question.
Well, when it comes to lender... Sorry, Pete, but when it comes to lender, someone like my organisation, for every 0.5% increase in the retail rate, we will lend a borrower 5% less. So we've had 2.5% increases plus a 0.25%. So basically, mathematically, we are prepared across the board to lend 12% less to the average borrower. So that means the average borrower's got 12% less to borrow, which means they've got 12% less to pay when it comes to buying a property, which, you know, mathematically you would expect the house prices for new purchases to go down by around 12%.
But all of these rate rises would have been factored in by banks, wouldn't they have, when deciding to issue the loan in the first place, if it was a few months ago?
Yeah, that is correct. And generally speaking, what happens is we take the retail rate, the rate we lend you at, and we add 3.5% to it. So we factor in 3.5% worth of rate rises. But what we probably didn't factor in, say, 9 months ago, was the increased cost of living. Yes. So generally speaking, when we do the assessment as well as all that, we look at your actual cost of living and or the average cost of living, and we compare the two. We take the higher of. But back then, the cost of living was nowhere near what it is now. We didn't have petrol prices the way they are, insurance costs the way they are, etc. We all know what the various prices are because we keep talking about it. So there is a lot of increased pressure on borrowers, particular first home buyers, and it seems to be from the statistics that are coming out at the moment, those people that have borrowed in the last 18 months are feeling the greatest impact, unless, of course, they took a fixed rate 18 months ago. So those people will feel the impact in about a year's time.
It's too late for that now, isn't it, going fixed rate?
Oh, fixed rates are north of 5% for 2 and 3 years, and I would say by the end of this calendar year, fixed rates are going to be like north of 7% for 2 and 3 year rates. So, and then look, there's an old saying that fixed rate never outperforms variable rate over a 5-year period. And funny, I thought it was going to this time round, like when it was at sub 2%. But here we are again in the rate rise period, and variable rates probably going to outperform fixed rate.
I have to tell you, Mark, from a personal perspective, my wife was encouraging me to take a fixed rate about a year ago, and I'm of the view that I like to attack the mortgage as hard and fast as possible. So I didn't take it. But now all these rate rises have come in, and I'm starting to get very nervous about the whole thing, particularly now that economists are saying that there's going to be another 0.5% rise next month.
Well, that's right. And because the Reserve Bank said in the last sentence of their statement yesterday something very important, which they've never said before. They remain committed to getting the inflation rate back down to the range of 2 to 3%. And they also made it pretty clear that they're expecting a 6% inflation rate come the end of July. So I think the August meeting might see another 0.5% for sure.
Yeah, the Assistant Treasurer on the program a little bit earlier, he believes that one's coming too. But I mean, final one here. I mean, it's important to keep some context here, because at the moment with the cash rates at 1.35, the last time it was there, May 2019, that wasn't that long ago, just a shade over 3 years. So is money still cheap, more broadly speaking?
Money is cheap in an absolute sense, per se. But if you look at the amount of money people have borrowed, the repayments are expensive. So unfortunately, cheap money drives more borrowing, larger borrowing amounts. So you can't just look at the price of money on its own. And we've got to stop listening to the commentators and the various other people who keep saying, yeah, but money's still cheap, because it's relative to the amount of money that's borrowed. So if you look at the amount of money that Australians have borrowed over the last, say, 3 years, they have borrowed a lot of money. Where it is cheap is for those people who borrowed maybe 5 years ago or 6 years ago who borrowed a lot less.
Yeah.
So there is a cohort of people, Pete, who are in sort of probably thinking to themselves, wow, this is going to be pretty expensive for me for the next few years. But it's a game. You've got to game it.
Yeah.
And we get our cheap periods and we get our expensive periods. But my guess is probably in 18 months' time, we're going to see interest rates either flatten out or come back.
And
that's when you game it again.
And there's still going to be a lot of people furious with the RBA governor who said that rates are going to be at 0.1% in 2024, aren't they? And then took a mortgage out based on that.
Yeah, 100%. And whether or not he was being irresponsible, or maybe one argument would be that he was being responsible at the time to encourage us not to feel flat and to get out and spend money and keep the economy going during the COVID period. But for every action, as Newton said in his third law, for every action there's an equal and opposite reaction, and we are now seeing the equal and opposite reaction right now.
Mark Bouris, always good to chat to you. Thanks for your time. We'll talk to you soon.
See you, Pete.